So when we start with statements of cash flow, statement of cash flow. For company, here we have a problem set for the year ended December 31st, 2025. So the first thing to note about the statement of cash flow coming from operating activity expenses. Cash flow from investing activities, and then cash flow from financing activities. So like the important thing to note about the difference between investing and financing activities is that you have to put yourself in the shoes of a corporation or like a company, pretty much. So like, because I'm not saying like a company could invest in like a stock, and that could be considered to be like an investing activity. But like, because whenever we think about investing, like as an individual, as a person, you think like, yeah, we're investing stock. You know, we're going to invest money into stock. So like anything related to stocks is like related to investing. And then like financing is kind of like, oh, I'm going to finance like one of the most common financing activities for people is going to be like, for example, like a car or a mortgage. Pretty much are those two things. Those two key things that can be considered to be a financing activity. But then you guys have to sort of look at it from the perspective of like a company. So like a company, well, first off, like the financing activity of a company isn't gonna be stuff related to financing a car or like a mortgage. They're not gonna, when it says financing activity, this cash flow statement related to financing activities, it's not related to like taking a loan out to get a vehicle, or a mortgage. What it is a financing activity for a company is issuing bonds or issuing stock. Um, that's what it means to finance, because the way the company finances, as in like the way that they borrow money, is by issuing stock. So it's going to be things related to the sale of stock. It's going to be things related to bonds. It's going to be things related to dividend payments, related to like owner's equity, pretty much. It's going to be things related to financing activity. While investing activities, if, for example, like it's a current asset, what a current asset is like an asset that's going to be used up within a year. So you can't really consider it to be like an investing activity. Like you're not really investing with this asset. Rather, you're using this asset in operations and the operation activities, and you're gonna be this asset's gonna be used up within a year. It's a current asset. Um, So then if it's an so like one of the things that is a very common operating um, a asset that's used in operations is inventory. Inventory, you're not really holding onto this inventory for investing purposes. Rather, you're holding onto this inventory to be used for operations within the year. This inventory is supposed to be going out within the year, less than a year, really. You don't want to hold on to this inventory for longer than a year. So if it is longer than a year, this is more of like a long-term asset. So like that could be considered to be like something related to investing. Um, or it could be things such as like land, you know, the sale of land, the sale of buildings are most common long-term assets that are sold and bought for investing activities. So like so how the statement of cash flow works when it comes to the indirect method. Because there's going to be the accrual method, which is not, so like the accrual method is not really like when the cash hits the account. It's more about like when we record the transaction. And then the cash is sort of like the amount that we have on hand, rather than like um, and because of this, there's gonna be the double accounting. You know, you're gonna double count this, um, and so that's why we have this indirect method, this cash-based counting method. So like, because we don't want to double count this, as in like, the cash is gonna already be there because that's the cash that's the total after everything. But the thing is, there's like a lot of stuff that happened that we have to like deduct or add into the net income to adjust for that. So then we reconcile the net income to net cash flow. So let's start with, I was going to say, cash flow from operating activities, the net income. Okay. The net income, assume that, where's the net income? Costing, blah, blah. All entries. Profit before tax. Net gain. Calculate net income for a statement from a balance sheet. So like the net income is like not provided, so we have to calculate net income. Calculate net income. Okay. So we'll compare. Because there is retained earnings. And then an account for dividends paid. So here's the equation to calculate net income. Net income equals ending retained earnings minus beginning retained earnings plus dividends paid. So that means that ending retained earnings was 841,500. Beginning retained earnings was 589,000. And then the dividends paid. So this was the if 12/31/24 dividends paid was 17,000 and 12/31/25 dividends paid was 15,000. What is the dividends paid? Oh, here's the income, 267,000. The cash dividend declared was 24,000. So 41,500 minus 500,000 plus 24,000. Yep, should be 267,500. Okay, well, might be wrong, but the net income is 267,000. Okay, and then now what we have to do is we have to make adjustments to reconcile net income to net cash flows. Okay. From up activities. So there's going to be depreciation most likely. So as you can see, depreciation accumulated depreciation 45,000, 455,000, and 12/31/2025 was 436,000. What is the depreciation for income statement of cash flow? Well, the amount of depreciation, I suppose, decreased. I'm not sure if this is 19, will it be 19,000? So 455,000 minus 436,000. 19,000. like the change of depreciation. Gain on sale of land, if there was any sale, which there wasn't. So there was no gain on sale. Changes in current operating assets and liabilities. Let's see. What you have is an increase. Well, do we have an increase? We actually have a decrease in AR of 45,000. So there's actually a decrease in accounts in AR. Okay. So that means that 44,500. I'm not really sure why the depreciation decreased. Of all things, it's kind of odd because usually it accumulates. The depreciation accumulates, but it appears that for whatever reason in this case it doesn't. But decrease in AR, as in like you guys have to think of AR. AR is accounts receivable. When a company has um, a sale and they have it on credit, for example, then it's like that's gonna be accounts receivable because they haven't received the cash, but they have an account where they plan to receive this cash. So like if the AR decreases, that actually means that the AR has been paid because the account has decreased. The AR account has decreased, but that means that the cash has increased. Okay? So this is the indirect method. This is like really confusing, I know. Like if you guys need to look up what a indirect method is, totally understandable. Let's look at inventories. So there's been a decrease in inventory. Okay? So the decrease in inventory. The inventory has decreased by decrease in inventory of 11,000. And let's look at accounts payable. There's actually been an increase in AP. Right. Let's see. 11,000. So then that means that because if accounts payable has been paid, that means that the company has paid off some of the account. That makes any sense. Let's see, is there accrued expense payable? Expense payable So now what we can do is we can calculate the net cash flow. Okay. Net cash flow from op activity. Okay. So what we do is, let's see, 808 plus 7,000 minus 4,000 minus 9,000 plus 8,000. Okay, so net income was 267,000 minus depreciation plus decrease in AR plus decrease in inventory plus the $274,500. All right. That's the net cash flow from operating expenses. So now cash flow from investing activities. So let's look. Do we have cash received from a sale of land? Sorry. There's also equipment. Inventories, actually. Oh, I already did inventories, but there's this equipment. Equipment. As you can see, there was an increase in equipment. Oh, it's is it? This is investing activity. So let's start with that equipment. Increase in equipment. So 475,000 was used purchased with cash. Okay. Increase in yes. Okay. Well, what is the investing activity when it comes to equipment? Um, hmm. um, Well, I guess it's not like when it comes to equipment, it's not like an increase in equipment. Um, Although this could be wrong. So like this purchase of equipment, okay? So that means that a total of $475,000 worth of equipment was purchased. Okay. And then sale um, of equipment. Proceeds, total cash received. Proceeds from sale. Sale of equipment of 127,000. Okay. That was fully depreciated. Was sold for 21,000. So um, sale. That was the sale of equipment. Purchase of equipment, sale of equipment, and I guess the proceeds of from sale of equipment. The proceeds was 21,000. Okay, so there's been an increase in cash, so because it's been fully depreciated already. Um, but like there's also proceeds from that fully depreciated equipment. Um, no buildings, no land was purchased or sold. So then now we can get the net cash flow used for investing activities. So the net cash flow was actually negative 327,000 because of that that purchase of equipment. As in like cash, that's how much cash was taken out. Um, that's the net cash flow. Now for financing activities, was cash received from the sale of common stock. Common stock. Cash stock was issued. Cash. Income. Cash dividend. payable, common stock. So yes, they did issue stock. They issued 10,000 shares at $3 par. That would be considered a sale of common stock. So cash received from sale of common stock. $30,000. That was how much cash was received. Was there bonds payable? There wasn't any bonds payable. But paid in capital in excess of par. So if there was an increase of paid in capital in excess of par, common stock, how do you write that? A statement of cash flow. So like if the paid in capital in excess of par common stock, what that basically means is that 10,000 shares was sold at $3 a par. That's how much it is on par. That's like the number that they have to have a number, SEC. Sort of like a manufacturing, like a MSRP of like how much that stock should be considered at. But then they have like a paid in capital, but like at market rate, they actually were able to sell this stock above par. And then like they had an increase in that amount. If you guys see how much they actually sold it over par. So they sold it actually $372,000 over par. Cash received from the sale. Is this sale or is issuance? Okay, well, we'll just say sale issuance of common stock. So like they sold 30,000 plus how much they had over par, 30,000. So total amount they received was 402,000. Okay. And then they had this cash dividend payable. $15,000. A decrease means that they paid dividends. So like the payable account has decreased. Okay. So cash paid for dividends. they pay 2,000. So now we can calculate the net cash flow from used for financing activities, 400,000. So now we can do the net increase in cash. Right, it's gonna be 347,500. Right. The net increase was 347,000. That's the net increase in cash. So the cash balance in January 1st, I guess, or no, we'll do December 31st. I guess that's when I don't know what, because we do have the cash balance on that date right here. See, 1,341,750. That's the cash balance, and the cash balance for the at the end of 2025. If we had to add these two together, oh, it's off. Because it should be. What is missing? 44,000 is missing. Huh. Sold that much. Proceeds that much. See, if equipment was purchased for 475,000, and then equipment cost 12,000, sold 21,000. What? deduct the gain. Suppose we could do that from there. Proceeds from, as in the gains from sale. Oh, well, we forgot to. Because the gains on sale actually should have been negative. Because we don't want to double count it. In the operating activities from the net income. When you guys you have to deduct it from the net income. That's third, so it's still 23,000. So 127,000 removal is actually a non-transaction. So then that means we don't have to write this in. Per 20 done under cash received. From sale of equipment is positive cash flow. And then let's see. It's 19,000. Decrease in AR. Decrease in inventory. Increase in AP. depreciation, um, decrease in AR. Excellent. Should be 300. That's what it should be. There's almost 100,000 that's accounted for. That's quite a lot. I wonder where. It's probably equipment. I don't know what else it would be. 23,500. Cash from sale. Costing. Sale of equipment. $40. 805,000. 500. So there should be 25,000 somewhere. 25,500. Somewhere. Is or inventory. Okay, don't sell equipment. I wonder where. decrease in AR. 5,000, it decreases inventory. 1,000, increase in AP. Gain on sale equipment. It's all there. And then the sale purchase equipment, sale equipment. And then cash dividend payable. Cash received from issuance of common stock. 3,000. And paid in capital excess power. Cash dividend declared of 24,000. Even if the cash dividend was declaratory for 1,000, only 2,000 came out from the dividends payable account. Um, Maybe it's not. Is it? It's actually this? There's some kind of thing that's like it's $40,000 off. I don't know what the heck there could be that's 40,000 off. Oh man. I think I accounted for everything. Accounts payable, dividends payable, common stock, accounts receivable. What could that be? $40,000 is quite a large number.